Now, what do we do with these measures of the sensitivity of the bond price to a change in the interest rate? One application is to know what the risk of your portfolio of bonds actually is with respect to a change in the interest rate environment. So if we have a portfolio that simply consists of 30-year zero-coupon bonds, we should know that this portfolio is very risky when it comes to changes in the interest rate. So with moderate fluctuations in the interest rate, we'll have large swings in the value of our portfolio. Now, another application will be the hedging of bonds. So suppose this is the scenario, that we're in a situation where we've got in our portfolio, say, $1 million worth of Treasury bonds. And these bonds have 20 years to maturity. They have a coupon of 8%. And it turns out the interest rate environment today is 8%, so they are priced exactly at par, exactly at 100, and the value is $1 million. Now suppose that I think that there's a risk that interest rates may increase over the next year. Now, if interest rates increase, we know that the value of this portfolio of bonds will decrease. And we can calculate the modified duration or the elasticity. And if we do that, given the current interest rate environment, we'll find that the modified duration is approximately 9. So that means that if interest rates increase by 1%, the value of the portfolio will drop by 9%. So our $1 million portfolio will lose approximately $90,000. So what are we going to do about this? Well, one thing that we can do is to hedge. Another thing we can do is to actually just get rid of the bonds. So we think that rates are going to go up, why don't we just sell our bonds? Well, it might be that we need to carry some bonds in our portfolio, that we just can't liquidate our bonds and put them into cash or into stocks. So we might want to keep those bonds in our portfolio, but we'd like to protect ourselves against changes in the interest rates. It also might be that we don't want to sell these bonds because we would incur the transactions costs of actually selling. And these transactions costs are commissions and bid-ask spreads and other things that we'd want to avoid. Another reason perhaps to hedge our bonds. So what are we going to do? Well, the first step in hedging is to assess the risk. In our case, if interest rates go up by 1%, it means that we're going to lose approximately $90,000 on our portfolio. The second thing to do is to assess the sort of position that we need to take to offset this type of risk. The position that we would take would be a so-called short position in the Treasury bond futures market. Okay, now that needs a little explaining given that we haven't talked about futures yet, and we really haven't talked about short positions yet. So, let me try to explain briefly what the futures market does and what a short position actually is in the futures market. And the best way to explain this is not with a bond, but with an agricultural commodity. So, in our situation, the bad scenario is the price going down. This means, as we talked about before, that the interest rates will have gone up. In a higher interest rate environment, the price will go down and the market value of our bonds will decrease. Well, the futures markets began hundreds of years ago, and when there really wasn't an active market in Treasury bonds. The markets actually began in a response to agriculture, and farmers actually initiated the need for a futures market. And the farmer's problem is very similar to the problem I described with the Treasury bonds. That the farmer is growing a crop, and the farmer is usually levered in terms of borrowing to the bank for farm equipment and other things. And if the price of the commodity that they are actually growing decreases substantially, then they will not necessarily be able to make the payments to the bank and might actually lose the farm. So there is an incentive for the farmer to actually hedge. And the farmer will hedge by using the futures market. And consider the example of corn. And suppose the corn is currently trading for $4 a bushel. And the farmer knows that if the price of corn goes below $3 a bushel, that will cause bankruptcy. So what the farmer can do is to sell in the futures market the crop of corn that the farmer expects for a price, and that price might be $4 a bushel. Now, if the price of corn actually goes down, well, the farmer has agreed to sell at $4. So the farmer's protected. Now, who's going to be on the other side of this transaction? Well, it could be a cereal company. Kellogg's might need the corn for cornflakes. And they're pleased to buy at $4 because they fear that the price might go up to $5. If it goes to $5, then that might affect their competitive position in the cereal market. Kellogg's has got a so-called long position in the corn market, where they've agreed to buy. And they've agreed to buy at $4. The farmer has agreed to sell. And the farmer's agreed to sell at $4. Now, how does this actually work? Well, it turns out that the mechanics of the futures markets are as follows. That if, for the farmer, the so-called bad scenario occurs, the bad scenario being the price dropping, price of corn drops from $4 to $3. What happens is the following. The futures contract is rewritten for the farmer, and the farmer must sell the corn at $3 a bushel. Now, this seems like a bad deal, but it turns out that the farmer is compensated for it. What happens is $1 is transferred into the farmer's account in order to get the farmer to rewrite the contract down to $3 a bushel. That $1 is being transferred from Kellogg's. So Kellogg's pays $1 in order to get the farmer to sell the corn at $3. Now, think about this. The farmer sells the corn at $3 a bushel, but has got the extra dollar, so really the price is $4. And Kellogg's has paid $1 to the farmer, and Kellogg's gets to buy at $3, which is a good deal compared to $4, but they paid $1, so really the price is $4. Now, this rewriting the contract occurs because we want people to continuously trade and enter this market and the market to be as liquid as possible. But the main intuition is that if the price of corn decreases, the farmer is protected. If the price of corn decreases, there's money that's going to be transferred into the farmer's account to compensate the farmer for the lower price. It works exactly the same way in the Treasury bond futures. So our person that's got $1 million in Treasury bonds, that's worried about interest rates increasing, could take a so-called short position in the Treasury bond. And if interest rates do increase, then that means the price of the bond will go down and money will be transferred into the person's account. Now, the goal of the hedge is to make sure that the money being transferred in from the futures hedge exactly offsets the money that you would lose in terms of the market value of your bond portfolio. So if interest rates do increase by 1%, that means that the value of the portfolio should drop by $90,000. Ideally, we would like $90,000 to come in to our account from our hedge. That would be a perfect hedge, and that's usually too much to ask for. But if it's close, then we've done a fairly good job at our hedge. So the hedge provides an offsetting cash flow. The hedge protects us against the so-called bad scenario, in our case, increased interest rates. Now, the last and final thing that we need to do in terms of hedging is to assess how big of a position that we need to take in terms of our actual hedge position in the futures market. And this is where modified duration comes in. The example that I gave you was extremely simple in that we had $1 million, 8% coupon bond, and the interest rate environment was 8%. It turns out that the bond that is traded in the futures market, the U.S. Treasury bond, has got 15 to 20 years to maturity and carries a coupon of 8%. This is exactly the same bond that I hypothesized that we held in our portfolio. Hence, if we have $1 million worth of bonds in our portfolio, we would take a short position in the futures market exactly equaling to $1 million in terms of market value. So-called one-to-one hedge occurs only if the bond that you hold that you're trying to hedge is identical to the bond that is traded in the futures market. Now, let's change things a bit. Suppose that instead of holding $1 million worth of 8% coupon bonds, that we had $1 million worth of 20-year zero coupon bonds. Okay, now we have $1 million in market value, not $1 million in face value. And remember, a zero coupon bond with 20 years to maturity, it's probably got a price of around $30. So I'm talking about the market value or the price of all of the bonds that I hold equals $1 million. Now, what do I do in terms of hedging this? Well, first I'll tell you what you don't do. What you don't do is to take a position in the futures market exactly equal to $1 million. That mistake is called the mistake of the naive hedge. The naive hedge is a result of thinking that the maturity of the bond is the same thing as the sensitivity of the bond to a change in the interest rate. The bond that's traded in the futures market is an 8% coupon bond with 20 years to maturity. The bond that we hold in our portfolio now is a 20-year maturity bond, but with no coupon. Now we know already that that bond has much greater sensitivity to changes in the interest rate than the coupon bond. The modified duration of this bond is approximately 18. The modified duration of the bond in the futures market is approximately 9. So what we have to do is to modify the sort of hedging that we do. If we implemented the naive hedge, and if the bad scenario occurred, what's going to happen? Well, as interest rates increase by 1%, the value of our portfolio is going to drop by 18%, or $180,000. Now, a good hedge will pay us off $180,000. But if we have implemented the naive hedge, as the interest rates go up, the bond price will go down, and the bond in the futures market is going to go down by 9%. The money that will be transferred into our account will be only $90,000. So we are short by $90,000. So you can almost guess what we should have done. What we should have done is to go into the futures market and go short $2 million worth of the futures. With $2 million, then we'll have an offsetting cash flow of exactly $180,000. So what we need to do is to take a position in the futures market that provides the identical cash flows to what we've got in our portfolio. Our portfolio had a modified duration of 18. The futures has a modified duration of 9. Therefore, we have to go 2 futures to every one that we're holding in our portfolio. Where do I get the ratio, or where do I get the number 2? It's simply 18, the modified duration of what I'm holding, divided by the modified duration of the futures contract, which is 9. So we have to go 2 for 1, not 1 to 1. So modified duration is quite useful in establishing the correct hedge ratio for managing our interest rate risk. So this is extremely important stuff, especially for banks, savings and loans, who really cannot afford to take a lot of interest rate sensitivity. So for a bank, a large swing in the interest rates could put the bank under. And given that you want to avoid that situation, you want to make sure that you know exactly what your interest rate sensitivity is and how much at risk you are for various changes in the interest rate. And you'll want to make sure that you set up a hedging program to protect the bank from changes that are unanticipated in the interest rate. This is called interest rate management. And modified duration and price elasticity are integral to this interest rate management.